All right, let's dive right in. But before we get started, just a quick heads up. This is purely for informational purposes, okay? It is not financial advice. Every single trade involves risk, so you've absolutely got to do your own homework. Cool? Let's go. 90%. Take a good look at that number. That's not a guess. It's not some myth that gets passed around on trading forums. Nope. It's a statistic that has been shockingly consistent for more than 3 decades. And yeah, that's exactly what it is. It's the documented failure rate for retail traders. We're talking about everyday people, probably a lot like you, who are trying to make it in the markets. And yet, for 30 years, 9 out of every 10 have failed. So, the big question is, why? Okay, so we're going to get into the 90% problem. And look, it's probably not what you think. You've heard all the reasons, right? And almost all of them point the finger right back at you, the trader. But what if? What if the real reason has less to do with your psychology and a whole lot more to do with the game itself? I mean, let's talk about the usual suspects. I'm sure these look familiar. Oh, you're trading on emotion. Your risk management is terrible. You just need more discipline. You don't have a plan. Sound familiar? We've all been beaten over the head with this stuff. We're told that if we could just, fix ourselves, our trading results would magically get better. But here's the thing, and this is the big reveal. They're not the cause. They're the symptoms. Every single one of them is a symptom of a much, much deeper problem that's built right into the structure of the market. And I'm telling you, once you see what's really going on, you will never look at a chart the same way again. So let's talk about the game behind the game. To really get what's happening, you have to meet your counterparty. We need to pull back the curtain and understand who is actually on the other side of every single one of your trades. So let me ask you a question. Just think about it for a second. When you hit that buy button on your platform, who do you think is selling to you? Seriously, who is taking the other side of that bet? Because most people have this picture in their head, and, well, it's completely wrong. The myth is that you're trading against, Dave from Ohio, some other retail trader who just happens to want to sell at the exact same moment you want to buy. But the reality? Oh, the reality is something else entirely. You're trading against an institutional market maker, a professional. And when I say professional, I mean it. You're trading against giants. We're talking about firms like Citadel, Susquehanna, Virtue. These aren't just companies. They're trading desks with billions of dollars in capital. Their computers execute trades in microseconds. And here's the absolute kicker. They have full visibility of the order flow. They see where you and everyone else are putting your orders. And that's the key right there. They don't need to predict the future. They don't need a crystal ball to guess where the market is going. Why? Because the system itself is designed for them. They're not playing your game. They are the game. They're the house. So how does the house win? How does this whole thing actually work? Well, it all comes down to the structure of the trap. A trap that, honestly, most retail traders walk right into without even realizing it exists. All right, the big idea you need to get your head around is something called visible liquidity. Just think for a second. Where does everyone put their stop-loss orders? It's always in the most obvious places, right? Right below a big support level or just above a resistance. Well, when thousands and thousands of traders all put their stops in the same spot, it creates this giant glowing pool of orders, a pool of liquidity that the market makers can see clear as day. And this is how the stop-loss trap works. Step 1, retail traders do what all the books say to do. They place their stops in these really predictable spots. Step 2, all those orders clustered together create that visible liquidity. And step 3, this is the crucial part. The market makers don't run from that liquidity. They hunt it. They're drawn to it like a magnet because they know they can push the price just a tiny bit, trigger all those stops, and scoop up the liquidity. Now, I want to be super clear about this. This is not some tinfoil hat conspiracy theory. This is just market structure. It's how the plumbing of the financial system works. The 90% who lose, they're not losing because they're dumb. They're losing because they're playing a game and they've never actually been told the real rules. So what's the answer? You can't change the game, right? You can't change the structure. But what you can change is how you play. It means you have to start thinking differently. You have to adopt an institutional mindset. It's a whole new way to see the market. Pay close attention here, because this might be the most important thing you'll hear today. Your edge, your advantage in the market, it cannot come from trying to predict what's going to happen next. The institutions don't do it, and you certainly don't have the firepower to pull it off consistently. So here's the big difference. Retail traders, they look at a price chart and they guess.
They try to predict, I think it's going up. But institutional traders, they look at positioning. They see where the liquidity is, where the big orders are stacked up, and then they just wait. They wait for the price to react to those areas. See the difference? It's not about guessing, it's about reacting.
And this means we have to completely change our definition of what winning is. It has nothing to do with being right all the time. Winning is about finding asymmetric risk. That means you're patiently waiting for those one or two setups where the potential reward is just huge compared to the tiny amount you're risking. That's it. That's the whole game. So your real edge, it's not some magic indicator you can buy online. The real edge is patience. It's learning how to analyze positioning. It's waiting for the conditions to be overwhelmingly in your favor. And most of all, it's about protecting your capital, guarding it. Because let's be real, for a retail account, that capital is everything.
Okay, let's wrap this up. Let's rethink your edge and talk about the actual path forward. This is about completely changing how you see the market and what you do every single day you sit down at your screen. Here's the new framework. It's 3 steps. It's simple, but it changes everything. Number 1, you have to stop thinking of the market as a fair fight. It's not. Number 2, stop just memorizing chart patterns and start learning the mechanics that actually make those patterns form. And 3, you have to understand deep down that price alone is useless. You need context. Look, this might be tough to hear, but it's the truth. The market does not care how hard you work. It doesn't care about your passion. It doesn't reward effort. It rewards one thing and only one thing, being correctly positioned.
And really, this creates 2 totally different kinds of confidence. There's confidence built on hope, which is what most retail traders have. They're just hoping it works out. And then there's confidence built on structure. That's the institutional mindset. You're not hoping. You're acting because you understand the underlying mechanics are in your favor. So I'm going to leave you with one final question. And I want you to be really honest with yourself. After hearing all this, are you playing the chart? Or are you ready to start playing the game,